Brad Williams. Frugal Finance, how does paying down a mortgage work? Again, this information is from the CFPB. Amortization, fancy word for your principal and your interests are broken down where you're going to pay a larger portion of your interest up front over, say, a 30-year period than at the end. And I'll show you an example here in a bit. The amount you borrow with your mortgage is called the principal of the mortgage balance. Each month, part of your monthly payment goes towards paying off the principal and part pays interest on the loan. Interest is what the lender charges you for lending you money. Most people's monthly payments also include additional amounts for taxes and insurance. The part of your payment that goes to the principal reduces the amount you owe on the loan and builds you equity. The part of the payment that goes to interest doesn't reduce your balance or build you equity. So the equity you build in your home is much less than the sum of your monthly payments. With a typical fixed rate loan, the combined principal and interest payment does not change over the life of your loan, but the amounts that go to principal rather than interest do change. And I'm going to take you to a spreadsheet, and I have another website. It's called Excel Prime, and I have a bunch of courses there. Here is just an example. I used a car payment, but the principal is the same. We're going to use $12,500. That's the loan amount. The interest rate is 6%. The term is over 5 years. So what we're going to do is we're going to take this 12.5. Let's say it's $125,000, 1.2 million. It doesn't matter. You can change this number any way you want. Then you're going to have your monthly payment. This is just a simple calculation right here. I'm going to enlarge this, make it a little easier to read. Here we have this formula, and this is just your monthly payment. Notice it doesn't change over the 5-year period. It's a 30-year loan, it'd be the same. Here is your monthly interest factor. This is the key number. This determines your interest payment. This is simply your interest rate divided by 12. We use 6%. Then we're going to take E3, which is this number, 0.005, and we're going to multiply that times C3. Here's your loan amount. Your first month interest will be $6,250. Then you're going to take this $12,500 minus $6,250, and that'll be your principal on your $241 a month payment. Then your outstanding balance will drop to $12,320, which is only $12,500 minus the principal. This $12,320 comes down to here. I just rounded it up, and we do this repeatedly. And as you can see, and there's some hidden rows here, you can see after the 42nd payment, the interest amount went from $6,250 to $2,185 to $219. Now, if you want to do this, I could change this to $400, and I need to change this, equal this. Here we go. You have a $400,000 loan. Keep in mind, this is only a 5-year period. Your monthly payment is $77.33. We have a 6% interest rate over a 5-year period. You're going to see your interest is going to be $2,000. Your principal is $57.33. Your outstanding balance is $394. And you can see over the first year, your principal is only going to go down to $329, and your interest is $16.76. And then come a month 60, you're going to pay this thing off. So there you go. If you have a very, very expensive car, or if you have a short-term mortgage, you can see how this works. It's pretty basic. You can change this number. This formula here, all we're doing is taking the timeline, 6%, and divide that by 12 because it's on a monthly basis. Then we need to discount this over a 5-year period. Then we're just going to use this other factor to come up with this payment. Check this out at excelprime.com. How does mortgage amortization work? I think I just explained it, but in the beginning of your mortgage term, you owe more interest because your loan balance is still high. Most of the monthly payment is applied to the interest you owe, and the remainder is applied to paying off the principal. Over time, as you pay down the principal, you owe less interest each month because your loan balance is lower. This means that over time, more of your monthly payment goes to paying down the principal. Near the end of the loan, you owe much less interest, and most of your payment goes to paying off the principal. This is known as amortization. There's other helpful tips here. I have videos on the various links here. Taxes and insurance, this would be your escrow. Your principal and interest payment, I just explained, and your fixed rate loan, I was just explaining a simple 5-year amortization. It could be a car, it could be a home improvement, it could be your house, it could be anything that has an amortized format. Leave your comments. Brad Williams, Frugal Finance. Thanks for watching. See you soon.